for that little delay, and we'll go ahead and kick this off. So welcome everyone. Let's see, make sure you can see and hear me. Rushing around here a little bit, but there we go. Oh, this is off a little bit. Oh well, probably look better with it off anyway. Just kidding. All right, so yeah, soon to be living on a ranch. Can't wait. So good morning or good afternoon or good evening, depending on where you are in the world. Welcome to Trading Coach's Corner and our Trading Coach's Playbook. Sorry, changed the name there, I guess. Anyway, Brendan Wendell. And before we get started, I just need to remind everybody, we're just doing this for educational purposes. I'm going to look at the markets, but I'm not going to make personalized recommendations about the markets, buying, selling, or anything like that. All markets do involve the risk of loss. This is always a situation. No matter what we do, we can never eliminate that risk. We just try to minimize and manage whatever risk we come across. And we're also not subject to trading restrictions, so we can have positions in a security or initiate one at any time. There we go. So that being said, actually, I want to log into something as well on a different page. It had a request. And let me just minimize this. There we go. So many things on this computer, too many screens. But anyway, if you want to keep in touch with us at Wealth Builders HQ, we got a lot of things going on. I am primarily pretty busy, tied up with what's called the E-mini Think Tank. You can see I've got my E-mini Think Tank shirt right here. And what we do is meet 3 days a week, Mondays, Wednesdays, and Thursdays, and take a look at what's going on in the futures markets. And not only just the futures markets, but I mean, we look at everything that's going on and how we can take advantage of those opportunities. There's, let me go right here. I logged into the member section of that E-mini Think Tank, and you'll see that there are trade ideas that I put out on a regular basis. All the classes are recorded, so if you can't attend live, you can go ahead and see them just in the recording, or if you miss something in the live session, you can watch in the recording as well. My microphone is tuned up as far as I can really go, so I don't want to go any higher. If I sound kind of low, I don't know if it's on your side. I don't know. Sorry. But yeah, I did the adjustments, and the levels are coming through on my side fine. So hopefully I sound okay. Anyway, like I said, the classes are all recorded, and in addition, I put out ideas. We look at the markets on a regular basis. As a matter of fact, let me see, where's that one? I was going to bring up one of the trade ideas that recently happened. I believe, yeah, 731. And the reason why I'm bringing this one up in particular is because it kind of pertains to what we're going to talk about today, which is trading gaps. So basically, every session that I do in the E-mini Think Tank, I start off with a PowerPoint that actually gets emailed to everyone. So even if you don't attend the class live, you still get all the information as well. But on Wednesday, I think it was the 31st, they have the disclaimer, how to contact us. I even have cancellation criteria for trades. And I find opportunities to kind of practice what we learn. And when I say what we learn in the E-mini Think Tank, just below here, you see there are bonus videos that are educational in nature. So for instance, today, we're going to be talking about gaps. If I zoom in, there we go. You can see that there should be a section on gaps and gap play. I think it might be in one of the other ones. And I'm revising all these. I'm going to be re-recording in my new studio because I'm actually moving this month into a new state, new property. And I got a studio where I'll be able to professionally record all these and update. Not only do you get the documentation, but there's also, not only do you get the videos, but there's documentation that goes with it that kind of supports all that information. And basically, every session, as I mentioned, we get to practice what we learned. So in particular, on Wednesday, there was a 15-minute trade opportunity on the NASDAQ, and it did really, really well. As you can see, there were actually 3 targets, not just 2. And the reason why it worked so well is we followed our rules. Not every position is going to work. As a matter of fact, this one was a loss on the Aussie. And, I'm not afraid to show losers because they happen. It's just part of trading. If you don't have any losers, you're probably not trading because everybody who does trade actually has winners and losers. It's just the way it goes. For instance, I think yesterday, if I bring that one up, that's August 1st. Yeah, I had loss, loss, loss. And this one I think is open right now. There's a second entry opportunity. It's profitable at this point. I'll have to take a look. No entry, loss. It happens. But the nice thing is about trading, if you can manage those losses and keep them relatively small compared to the winners, and you're consistent, and you can only be consistent if you have plans and routines that you follow, which I put forth in the documentation as well. And as long as those winners are larger than the losers small, even if you have more losers, you can still be profitable. It's pretty neat. So anyway, what I was getting at is we're going to talk about that NASDAQ trade a little bit today because it was available to us looking at a gap. So if I go NQU 2024, there we are. And I'm going to go ahead and remove my drawings for now and go to a smaller time frame. There we go. So when we look at a futures contract, typically, and by the way, before I go any further on this, I want to mention that everything I talk about with these gaps also applies to stocks. So you could use the same, or even indexes. You can use the same techniques and strategies and ideas when trading other things than futures. And the only one it really wouldn't work on is Forex, most likely. And the reason why is that the way the Forex trades, it is, really almost nonstop, except on the weekend. So looking at NASDAQ right now, if I look at this 15-minute chart, you're probably thinking, wait a minute, there's no gaps on NASDAQ either, right? It's trading 23 hours a day, 6 days a week, right? Begins on Sunday. There's a small gap there. Okay, that does happen. But for the most part, you're not seeing many gaps. So to see gaps on something that's traded more than the normal 6.5 hours of the equities market, you have to change your viewpoint. And one of the things you have to realize is that when I'm looking at these markets, I'm trying to identify what certain traders are doing. And really, I'm trying to identify what the professionals are doing, the big institutions. When you think about it, it makes sense because the big institutions are the ones who are making the most profits, the biggest buck, if you will. And if that's the case, we want to follow what they're doing and most likely copy them, right? So they're not trading 24 hours a day, especially not on something that's based inside the United States. You could see this if you add volume. So if I add volume to my chart, there we go. And I'm going to remove my RSI for now. You notice that the volume during what they call regular trading hours, or RTH, I'll refer to that quite often. Now, the regular trading hours is where all the institutional trading is going on in the big volume, but they go home at the end of the day. Now, there's still trading that does occur after hours, what we call the extended trading hours, or ETH. Okay. A lot of people also refer to that. It's not correct, but they refer to it as the Globex hours. And in reality, yeah, it's a Globex system. Globex is a system, not a time frame. The Globex, I think it was created in like 2005 or something. It's actually, I should probably add that. Globex is a system for order routing and matching. If you buy, you need to match your order to a seller to get your order filled. So Globex is a system for order routing matching that is, or was created by the CME many, many years ago. Whenever we as retail traders trade, that's the system we are using to send our order to get matched and filled. Okay, so it's called Globex, but some people call the extended trading hours the Globex session because that is really the only way you could trade outside of regular trading hours. The regular trading hours are a throwback, if you will, to the pits. If you go to the Chicago Mercantile Exchange right now, it's a very lonely place. There aren't many pits open anymore. Same thing in New York. If you go to the New York Stock Exchange, it's very open and empty. You can see it on television on CNBC sometimes. It used to be packed, shoulder to shoulder, traders screaming at each other in these pits, if you look at the old pictures. But everything, for the most part, has gone electronic now. And the Globex system handles those orders. But traditionally, the institutions will still follow that regular trading hour schedule rather than going outside and trading, unless there's something major going on. You take a look at that big spike in volume right here, right at the end of the day. Well, that may be earnings, because you could trade the futures contracts even after the regular trading hours have closed and the equity market stopped. If I take a look at the related security QQQ, which trades just like the NQ for the most part, first of all, you're seeing only regular trading hours here, and you do see big gaps. Now, if I go to the same day that we're just looking at, Wednesday of this week, I think it was, yeah, Thursday, there it is, Wednesday 31st, there you see a gap. Okay, so now it's much more obvious because this was 3:45 and there's 9:30 the following morning. But even the Qs have after hour trading. If I go to extended trading hours on my chart, there you see it. There's extended trading going on. And going back to where that gap was created, this is after hours and pre-market. So the reason why gaps are actually created, it's not because there's huge institutional trading through the middle of the night. Although if there are events that occur worldwide, there may be some trading that goes on in US-based securities to react to it, right? But you saw the volume is very, very low. What often happens is right around 8 in the morning, right about here, on any given day, if I zoom in a little bit more, actually go down to a 5-minute chart to break it down even further, and go back to that day, the 31st, there it is. There's that line that I mentioned at 8 a.m. on the 31st. It's actually happening a little bit earlier, I notice now, but it used to be 8 a.m. This is when, on the equity side, the stock side, you had participants called market makers. And if you're not familiar with market makers, they're the people who, well, to put it mildly, try to screw you over on your orders. Their job is to create a market, create liquidity in the equities markets. So they always stand by, willing to buy and sell securities. If you were to go out, you can actually find them. It's pretty easy. If you go to NASDAQtrader.com, I think it's still there. I haven't been here in a while. And right here, you can look for, it says MPID, that's market participant identification. So if I go to, so let's say, QQQ, since we were looking at that, let's see if it gives it to me. Here's the Qs. And it may not, nope, doesn't give it to me there. Let me see. I can click on market participant, the symbol. I think that's right, QQQ. Let me try it, see if it shows. Nope. There used to be a way to see market participant positions. Oh, there it is. That's what I was looking for. QQQ. And right here on Thursday, August 1st, they would show you the previous day. These are the market participants who were trading the QQQs yesterday. And you may recognize some of the names like Goldman Sachs, JP Morgan, StoneX, there's a bunch of Bank of America securities and so on. But you see, it says MP type M. M means market maker. And R, I'm not sure what that is, but obviously on this website, you can look it up. These are the people who are creating the liquidity. If you were to look at market depth in a chart, or not a chart, but a matrix, usually you look at the bids and asks for security. These are the participants that are on there making bids and asks to trade the security. And what typically happens is they used to get active at about 8 in the morning Eastern. The reason why is the equity markets open at 9:30, and they need to see what orders are coming in from their customers and how are they going to fill those orders, either from opposing pressure in the market. So if they get a bunch of buy orders from their customers to get a stock, they may need to find sellers in the market to make that transaction. If they don't, they will become the seller and sell to the customers. Well, that gives them a short position possibly, or they may need to exit longs that they had previously held. So going back to why there's a gap, for instance, on the Q, you can see at the end of the day, on the 30th, the market dropped quite a bit. And it looked like it was going to stay down. You see there's huge volume. That's usually from earnings after hours. The next morning, at 4 a.m., when they reopened, and you can see it started in the evening here all the way till about 8 p.m., and then the market shut, reopened at 4 a.m., and there's not much volume at all, if anything. But right around, and I said before, it's usually around 8 a.m., but notice as I zoom in more, it's actually occurring now at 7 a.m. So I don't know if they're just getting to the office sooner. Oh, hang on one moment. Okay. So yeah, it's happening around 7 a.m. rather than 8 a.m. You get that little spike in volume. The reason why is, think about this. If there's a bunch of orders coming in from customers, these market makers, as I said before, have to do one of two things. Either they have to find a lot of people who will sell or buy customers, or buy from their sell orders, the customers. And if there aren't any of those participants, they become that. So in this case, it looks like the prices were going up, even though it dove down a little bit at the end of the day. Oops. Hang on just one moment. There we go. So if there's a bunch of people who may be interested in buying first thing in the morning and they need to find sellers, they're going to start pushing prices up. So no, the gap doesn't happen at that time. The gap is from the closing price right around 4 p.m. So the gap itself, or really it's the settlement price. So it may not be right at 4 p.m., but it is actually what they call the settlement price or a close, whatever that closing price might be. And the gap is officially going to be the first official trade at 9:30 a.m. in this case on equities, the next trading day. Okay, so that is what the gap kind of is. So what's happening at 7 a.m. is that the market makers are getting to work. So right here, the market makers, and they're trying to position themselves to be able to to be able to get ready. I used to do this as a what they call order desk operator, or agency desk operator, agency desk operator. I worked for a company called Lloyd Wade Securities. They're still around. It's based out of Austin, Texas. I worked in the California office. So I would get to my desk and I would have, back then it was paper orders stacked up. So we would have all these buy and sell orders that came in from our brokers who either talked to their customers or the customers called them, whatever it was. And I would see how many buy and sell orders I had. I would then go to my computer. Back then it was a giant CRT monitor with all green. If you remember the monochrome monitors. And I would look to see what prices the market makers were setting up. And again, we would do this early around 8 a.m. But as you see, the volume now is starting to come in early. Why is it not spiking there? I had it. There it goes. You see the volume is getting heavy, relatively speaking. The overnight volume is getting picked up at about 7 a.m. rather than at 8 a.m. like it used to be. Now, in this case, it looks like there were probably a lot of buy orders from customers. So right before the market opens, they may have a lot of buy orders, like I said, from customers. Well, if they have a lot of buy orders standing by, they need sellers. And the only way they're going to find sellers when I say buy orders stacking up for the open, I'm talking about customer orders that are coming in. So when the market makers come in around 7 a.m., they see all these buy orders waiting. It's all on computer now. And they either are going to have to sell to their customers or find sellers. Well, the easiest way to find sellers is to change your bid ask, because during this pre-market time and even post-market, the rules are a little different in the game. These market makers can put in quotes to buy or sell securities without having to actually fill those quotes. And for the most part, all the market makers play the same game. They all see it going on. They pretty much have the same types of orders, if you will. So they're all raising the bids and offers to get the prices to open around 9:30, right near a supply zone. So all that selling pressure will fill all their customer buy orders. They make money on the commissions. Or they're buying during this time. If the market makers are buying during this time, when the market bell opens and the customers want to buy, they can simply sell out of their own inventory. And not only are they making commissions, but they made a profit by driving the price up pre-market. It's a win-win. Now, they should give the customers the price at where they bought it, but they're not going to, and they're not obligated to. They're obligated to give them the best price at the moment of process, which would be when the bell rings at 9:30. And you see that big jump in volume. And what typically happens is, because of that pre-market movement to try to get the inventory or drive prices to where there's going to be enough people to offset their customer orders or trade with their customers, that's why we get gaps. So it's an imbalance. It's order imbalance and a need to get those orders filled in a certain area. Now, it doesn't always open right at a supply or demand. So I'm going to move this line. Actually, the open was right here at 467.90. So if I look back, you'll see the last time we were there, prices collapsed. Why? There was an imbalance. There was a lot of selling pressure and no buyers, right? So if there's a lot of buyers, they're going to want to open price right into where any of these sellers that are still left over now have an opportunity to sell to the customers that are coming in on that morning. So it's just a big game. And again, it's all electronic now. So it used to take about 15 minutes, maybe 20, to get through all the customer orders. And once those customer buy orders were done, you would actually see a reversal first thing in the morning. So you used to get what's called the 10 a.m. reversal on the East Coast. Nowadays, it can happen within minutes, sometimes even seconds, because everything's electronic. It just boom, boom, boom. They fire off the orders and it just gets reversal almost right away, especially if there's a lot of selling pressure. And you can see when it opened, all those customer orders, huge volume there. It did go up a little bit, but then collapsed once all the customer buy orders were filled. And eventually it turned around again, and you get a second reversal. You get two. You get that first move or knee-jerk reaction, if you will, from the customer orders trying to fill. Once they're all flushed out of the system, prices reverse a little bit. Then once they, sometimes they'll come back to a demand area. You can actually see this here, another pocket where prices based and started to rally. And it wasn't really a jump in volume. I'm trying to see. Yeah, there was some decent volume on that move. There's more behind it, but notice as we started moving up, we got a slightly larger green candle. A lot of volume, so there's a lot of buying pressure there. And that's where we got our second reversal. So that's kind of interesting when you see that in action. And I used to watch it because, like I said, I was part of it, where I saw prices getting pushed in one direction or the other based on the orders that were coming in pre-market and trying to get those filled. Now, I mentioned on futures, you don't really have that, right? Because on futures, if I go to NQU 2024, those markets trade nearly 24 hours a day. However, again, you see that volume picks up right around 9:30, and it actually gets a bump. It used to be 8 a.m. Now 8:30, that was because of news this morning. I'm sorry, that was yesterday. That was still news, I believe. And back here at 7 a.m., there was another rise in volume. So what I've been noticing and watching this recently is that the market makers are getting in a little bit earlier than they used to. So I'm glad I don't have to do that anymore. Commute to an office and get ready to market make at 8 a.m. Now it's 7 a.m. So you got to get in there earlier. I mean, I guess if you're in Jersey City, the traffic's probably lighter at that time. I don't know. Now, I mentioned you're not going to see a gap here on the NASDAQ because it's trading nearly 24 hours a day. So how do we see gaps on futures? You eliminate the after hours trading and only focus on what's called regular trading hours. And if you're not familiar with regular trading hours on securities, bar chart's a pretty good resource for that. In the futures market, under the futures tab on barchart.com, you can go to contract specifications. And I mentioned Forex, it's kind of a weird animal, and even Forex futures that follows it, they don't have RTH. You'll see it right here under trading hours. So under indices, there it is. Now keep in mind, these are Central Standard Time they're showing. So I'll zoom in a moment first so we can see this a little better. And the NASDAQ E-mini, actually they don't show it here anymore on this one, but the NASDAQ E-mini shows it trades from 6 p.m. Eastern until 5 p.m. Eastern, Sunday through Friday. But we know that regular trading hours for equities are from 9:30 to 4 p.m. So that's where you see the heavier volume. And actually, if we go to energies, one of the other groups here, there it is, you'll see RTH, regular trading hours. So if you were to look for gaps on crude oil, on heating oil, on gasoline, nat gas, you would only want to chart that time frame. It's 9 a.m. to 2:30 Eastern, because this is showing you Central Standard Time. So let's do that. If I go back to NQ, there we go. Change it to regular trading hours. I'm on New York time because I live on the East Coast. And now we see gaps. Why? Because this stops charting and they adjust it a little bit. It's actually 4:15 p.m. where they do the cutoff and the reopening at 9:30. But you see gaps. And you wouldn't normally see those if you're looking at the hours that keep going. Be careful because, let's say crude oil, CLU 2024. Here, it's using the same hours. So when I go in and I said regular trading hours, this is not going to be correct unless you adjust them. It's showing from 4:15 until 9:30 a.m. But we know that for crude oil, again, the regular trading hours are 8 a.m. to 1:30 Central Time, or 9 a.m. to 2:30 p.m. Eastern. Okay, sorry, phone's going crazy with messages. It's a busy day. All right. So you need to adjust your charts or just make notes on your charts, whatever it is you want to do. Sometimes you can just adjust them. I'm not sure if I could do that here or not. I can create different trading sessions. I'm just going to do what's easiest for me, which is go to electronic trading hours, hit OK. And doesn't matter. I can go to today. There we go. And I can put a vertical line at 9 a.m. Actually, I'll put it just before, right there at 8:55. And going back to the previous day, there we are, 225. So this, if I want to see a gap on crude oil, I basically ignore everything between those two lines because that's after hours, right? And I can do, I guess, well, I'll make it easier. We'll do, well, no, I will do that. Where's the drawing tool? No, I just forget where certain tools are here. So I use too many different programs. There we are, rectangle. So if we just ignore the after hours, yeah, I'll leave it at that. And actually, I should put this on the, there is 2:30 candle. Close. And the reopening price right there. So in this case, crude oil gapped down. And again, you wouldn't see that unless you adjust the hours of the chart to only regular trading hours. Okay. So if you have questions about, Globex or how that works, actually, it doesn't show on this. I would look at the CME website. They actually have information on that. Additionally, I don't know if they have it. They don't have it on financials, do they? No. I know they have it on some others. The RTH. That's what I'm looking for. Yeah, on the grains, for instance, the regular trading hours. I mean, this trades, again, Central Time from 7 p.m. the night before, 8 p.m. Eastern to 8:45 a.m. Then the shutdown occurs. So for corn, the regular trading hours, you want to chart from 8:30, again, that's central. So I'll just use Eastern time to make it easy. 9:30 a.m. to 2:20 p.m. Regular trading hours. There you go. If you chart that, you will see gaps on corn. And if you go to metals, livestock, I think, has short trading hours, so that's all regular trading. If we go to metals, like gold, if you want to see a gap, use only regular trading hours, 8:20 a.m. Eastern to 1:30 p.m. Be careful because they're not all the same. Regular trading hours on silver is different than gold, as you can see. It's 8:25 a.m., 5 minutes later, to 1:25 p.m. Eastern. Okay. But the point is, if you only chart regular trading hours on futures, it's not all of them, it's many of them, then you will see gaps. Now, why do we even care about that? Well, if you were trading the NASDAQ the other day, as we were, and I'll come back to this chart in a moment, knowing how to trade gaps and identify gaps may give you an extra edge. It may give you extra trading opportunities. So again, going back, is the 31st. Here we are. There was a gapping opportunity. And if I look at this, there may not have been any opportunity I might have identified. There might have been, but most likely I might have missed this. Well, there was a pre-market zone potentially right there. Where's this? There we go. Got too many defaults. So right when the market opened, you can see it opened up, bounced, and took off. And you might have been able to take advantage of that. And I have, where did I put it? I posted it on Twitter today. And if you see, on Twitter, or X, I'm sorry, it's called X now. You can follow me if you're interested at Trader BW. Be careful. There's a lot of people now making fake accounts and they have like a small difference in the name. Okay, so there it is. I put it in the chat at Trader BW, not DBub. Okay, that was a fake account, so I did. Anyway, getting back to what I was trying to point out, in the mini think tank, we had that trade idea we came up with by watching the gaps. There it is. Bring it over this screen. Oh, thank you, Jennifer. She mentioned that she follows me on X. Well, thanks. Appreciates the notes. So right here, you can see you had a long entry, pretty much right at the open right there, and caught a nice opportunity. It was about, I think, 245 points all the way up to the third target. And I actually have to thank one of my students, Nick, because he identified this area of supply to take some profits before there was a pullback. So it was a really nice opportunity. But you notice this was prior day high, RTH only. Okay, so what the heck does that mean? Well, again, if you're looking at overnight, if you were looking at a 15-minute chart, you might not have seen any opportunity to buy in there. This was the buying opportunity right here that we took advantage of. And the only reason why we saw it, again, is we took it out the overnight and started viewing this as RTH, excuse me, RTH only, regular trading hours. Heck. Oh, I didn't mean to delete that, sorry. 31st, there we are. There's that buying opportunity. They're probably saying, wait a minute, why would you buy right there? Well, when I look at gaps, I kind of change it a little bit. Roman's saying that Musk should buy Facebook and call it W and Instagram Y. So you have XYZ. There you go. Yeah. Or WXY. WXY. I don't know. You can name something Z. Who knows? Anyway, so why would we look at this? I look at gaps a little bit differently than you see in a lot of books. A lot of books, you'll see things like professional gaps, novice gaps, continuation gaps, exhaustion gaps. Yeah, it's exhausting trying to memorize all those. So I try to simplify it a little bit more. And what I look for is, where's the price opening up? Are we opening inside or outside of the prior day's price action? That's all it is. That's much simpler, isn't it? When you look at a day, now let's pull it back to a random date right there. Actually, we have a couple of examples here I'll go through. So right here, That's a 9:30 open right there. Looking at the prior day, yep, there it is. That's the 9:30 candle on the 11th of July. Oh, I'm sorry, I went too far, didn't I? That's the 12th. And then this is the Monday, the 15th. So this was Friday. Okay. On any day, if you're only looking at RTH, let me get rid of the volume. There we go. Just focus on the chart. All we need to do is mark what was the prior day's high and what was the prior day's low. Oh, sorry, I'm battling allergies. So yeah, you have prior day's high, prior day's low. And there's actually probably indicators that will automatically draw it for you if you want. You know, you can just add those in on different platforms, whatever it is you use. I look to see where's the current open on this day. Oops, where's it here? I have snap mode on. Really? It's not going to snap? What's going on here? Oh, well. Anyway, you can see that that opened inside of the prior day's high and low. Inside gap. It's that easy. So if we have, now it's doing this strong magnet. Keeping it simple. Inside gap. Today's open is below the prior day's high and above the prior day's low, basically opening inside of the prior day's price action. So I didn't say yesterday's prior days, because if you have a Friday open, it's the previous, I'm sorry, a Monday open is the Friday before. So you're basically opening within the prior day's price range. That's it. Okay. Now I'll get to why I care. I'm just going to identify these types of gaps first. So if we go to the next day, there it is, the next open, same thing. I just look to see where is the prior day's high and prior day's low. That was at the open. And then open of that candle, well, it's below the prior day's high, above the prior day's low, inside gap. Just that simple. No need to guess what the trends are or anything like that. That's all. Simple works. We want to keep trading as simple as possible, because God knows we can complicate as much as you want. Where's the text here? I thought I had text. There we go. There we go. Prior high. I'm going to get to that. Great question. How do we trade those? Well, I'm going to get to that. Absolutely. Come on. See some font we can actually see. There we go. And this was prior low. Okay. What did I do there? Really? All right. Try it again. There we go. So we got prior high, prior low. There's we open inside. Okay. Now with inside gaps, and we'll shrink this down for the note. Usually they try to close. Oops. And they often try to close within the first 15 to 45 minutes of the new RTH. Now, do they always close? No. Everything in technical analysis always happens except when it doesn't. Okay. So typically they will try to close within the first 15 to 45 minutes of the regular trading hour. And what will often happen is, because remember, why is that gapping? There's an imbalance of buyer sell orders, right? Yeah, my Grammarly's correcting me here, but there we go. These are being caused because of imbalance and order flow first thing in the morning from institutional, maybe, but mostly retail orders coming in. So because of that, basically, once that order flow has been flushed through the system, you'll get a reversal. And that's where the gap fill starts to occur. I mentioned earlier that that can happen as quickly as a few seconds to a few minutes. It used to be 15 to 20 minutes. But what will typically happen is price initially will try to seek out a supply or demand zone to turn. And if you're not familiar with what supply and demand zones are, well, I've got that covered in, where is it here? Leg-based zoning technique. And I actually have an updated one I got to post there. But I have lessons on how to identify the proper ones to find where to get in, where to get out, and how to manage your risk. But typically, as I mentioned, prices will try to close on inside gaps relatively quickly. So the initial is either to a supply or demand, and then the gap fill. Now, sometimes if prices open at supply or demand, it'll immediately just try to fill the gap. Now, will all of them fill? No, of course not, as I just said. So going back, where was I here? Oh, was this the first one I noted? Yeah. Oh, no, I went forward here. So going back again, you got a bunch of different gaps you can mark. It happens quite often, especially on the NASDAQ. So right there's a gap up right here. There's the prior day's high and low, and there's your open, right? So what happened? We opened up inside the prior day's high and low. Fix the scale there. And prices ran for a little bit and then reversed, trying to close the gap. It didn't completely close the gap, but it tried. And the gap, I actually use 4 p.m. I know that some of these were showing all the way to 4:15 or so. And yeah, we'll use that. That's the close. Well, it tried to close the gap and eventually ran up. And actually wasn't until the next day, because that's the following day, where it actually closed the gap. So it did make a move down and try to close the gap. And were we at supply is the question. Well, if we were, it's pretty far back, and I'm not going to find it right now on this 15-minute chart, so I'm not going to bother. And we'll just go to the next one. So the gap would be prices going all the way back to wherever the prior day's close was. So if this kept going down, either had a wick. At the time, that wouldn't have been a wick. That would have been a solid red candle, and the price would be pushing down. So yeah, the gap closing is when prices hit it. At the time, it would be the body, but it may leave and leave a wick for a close. Yes. So we go to the next day. We didn't really gap on that day. There was the close. Open of the next day was pretty much the same. And then we go forward again. Prior day's high for the 11th. This was a big move. There is the low for the 11th. Okay. And where's the next day's open? No gap right there. So I'm not going to worry about that. Okay, we move on to the 12th. Oops, go back. Just try to find the highs and lows in the opens. That's all. Up there we have it. I had it marked anyway. So there is that high and the low. Nope, I take it back. The low was right near the open here at 9:30. So that's the high and low. The close from the 12th was right here at 4 p.m. There's your gap up, right? Obviously between the highs and lows. So it's not a big gap, but that should fill. It took almost the whole day to fill in this case, but it finally did right there at about 3:45 in the afternoon, finally filled the gap. And again, it looks like it was a wick that did it, but no, remember, this would have been a red candle as that was forming, as prices were pushing down. Okay. Now, there's another type of gap that I want to get to if I can find one. Right there. Got it right here on the 17th. And of course, the 31st is example of that one too. But there's the prior low. There's the prior high from the 15th. Okay. Bring one more candle into this. Oops. There. So here's our new open. And you know what? I want to change that color just so we know it's an open from a different day. Do the dark green. Close. It's right there from this day, the 15th. That is an outside gap. That's it, inside or outside. So today's open is below the prior day's low, or, because it can't be both, above the prior day's high. It's gapping outside of the price range. That's the only difference. Opening outside of the prior day's price range. And outside gaps don't usually fill very quickly. As a matter of fact, they may just stay open for a while. I mean, most gaps will try to close eventually. It may take days or weeks, months, sometimes only minutes. The Japanese actually refer to these as windows, which makes sense because, especially if you live here in South Florida, if you leave a window open over the next couple of days, we're expecting a lot of rain. You're probably thinking about it when you left your house. You want to get back to close it as soon as you possibly can, right? So same thing happens with gaps. Outside gaps do not usually fill right away. They may fill eventually. Usually do not try to close. And basically what will happen is prior days, high or low, it'll act as a bouncing point. So what the heck do I mean by that? Yeah, let me get that off that. Oh, actually, get rid of this altogether. So now we have prior low, prior high. This is on the 15th. Here's my open on the 17th. Okay. And as you can see, we're below the prior day's low. That's an outside gap. That gap is less likely to close. If it does try to close, what will often happen is the area or the candle even that formed the prior low, in this case, because we're looking at lows, that candle that formed that prior low will likely be a bouncing point for price. It'll be like a resistance level. Or if we gapped above the high, the candle, and I actually use either 5 or 15-minute candles for this. Okay, there's some other things you need to know. This is not everything. I only have so much time to go over this with you, so I'm kind of rushing it a little bit. I mentioned before, if you really want to know all the ins and outs of gap play and follow it, the E-mini think tank is where I do most of the detail work on that. So what'll happen, like I said, there's other things I include, but there's documentation here on gaps, and I'm adding more to it. There's also videos and lessons on it as well. But if you're interested in really seeing all the details, that's where it is. So be careful, because unfortunately I only have a little bit of time to be able to go over all this with you, and I'm not able to cover all the things you need to look for. But there's places you can find it, as I mentioned. So anyway, with this prior low, let's see if it came back to it. I don't know if it did on this day. Nope. As a matter of fact, that was the trading day right there. Never came back. So next day, that's an inside gap, right? We gapped up inside the prior day's price action, should close. And it did. very quickly. So if I take this all the way to, let me see, I can bring these forward so I can use them again. Yeah, I don't need to carry that one forward or that for now. And where is the 23rd? Oh, sorry, 31st, not 23rd. Oh, computer froze. There we are, 31st, Wednesday, 30th, 9:30. There we go. And where the heck is price? There we are. Move my text out of the way and bring this back. There's the low on the 30th and the high on the 30th. I think that was where it was. Nope, actually, I'm sorry, I'm on the wrong day there. Went back too far. 29th and 30th. There we are. There's the prior high. And we'll zoom in a little more so we can see all this better. There's the open. Okay, now we're better. So the open, it's a red candle. That's the top of the body right there. There's the open. It's above the prior high, right? Well, if we're above the prior high, that is an outside gap. Outside gaps typically do not close. Even if it's a little bit above, okay, it's still not likely to close. Closing the gap would require price to go all the way down to there's 4 p.m. closing price right there, down the bottom. And that's just not likely to happen right now or with this price action. So not going to fill that gap. However, this prior high kind of changes role. It becomes a support zone. I didn't say demand because it's not really demand. It's not leftover institutional orders, but that becomes a support level. And what happens is when this opened, you can see prices tried to go up a little bit and then collapsed. Actually, get rid of the vertical line there so you can see it better. So we opened, tried to rally, came down, touched the prior high, and we should bounce from there because it's an outside gap. And what happened? That was a great place to buy, wasn't it? You had a nice rally, and the end of the day, it's right here. Then we go to the next day. But that's another one to trade. So that's the NASDAQ trade that I showed you that we did in the E-mini think tank right there. 15-minute time frame, prior day's high, gapped just barely above, came down and rallied. And this program shows a little bit later than 4 p.m. It goes all the way to 4:15, so you got extra candles there. But that's all it was. Just simply identifying whether it's an inside or outside gap and taking the proper actions. Today, let's see, what do we have? Oh, we have an outside gap, don't we? There is today's open, green candle this time. That means we opened at the bottom of the body, right there. Well, the prior day's low. Actually, there's the close. So I can bring this over. Prior day's low. It's right there. And because that's the prior day's low, and we open below, if we were to rally to this point today, instead of closing the gap, now it's kind of close, so we might, but this is likely to provide a bit of resistance and maybe a selling area for the NASDAQ. And we haven't gotten close to it. Okay, well, it's not likely to continue to get up there. Even if it does rally at the end of the day, that's probably where we're going to end up pausing or stalling by the end of the day because this was an outside gap. Again, there are some other factors I look at as well. And go back to that crude oil example before we wrap this up, because I do have to. Same thing. You have the prior day's low on the 15-minute of crude oil. You want to ignore the after hours, which is anything from 2:30 p.m. until 9 a.m. the following day. Well, it's showing 9:30. It's not even showing 9 a.m. So this I've got to change again and look at electronic trading hours, or I have to set up a different regular trading hour session for this security. But I highlighted in the yellow anyway, so we can see That's an outside gap, isn't it? We gapped way below the prior day's close, and we're outside. That's not going to fill. If I go back to a different area, let's see. This is August 1st to 2nd. Let's see if we got August. Yeah, we can do 31st. Bring these lines over. It's got to find the right area. Again, it would be from 2:30 in the afternoon on the 31st. Let's back a little bit. That's why it's easier if you can actually set the dates or times for the regular trading hours. And then 9 a.m., not 9:30 on the 31st. Sorry, August 1st. That's what I'm doing. There we are, 9 a.m. So we're going to ignore everything between those two vertical lines, and we would identify a gap that way. You can see that we have an open 9 a.m. way up there. The high from the, oops, did that right? Oh no, I did it wrong. Sorry. This is the first we're dealing with. So the 31st, I messed that up. Sorry. Did the wrong day. That's why it's so much easier if you can just set the hours correctly and just go to those. So anyway, 9 a.m. on the 31st is right there. And then the end of the day, $2:30 right there. So the after hours is this. That makes more sense. And the high from the 31st was at 145, right? Let me just make sure, zoom in more. There we go. No, it actually was at the last candle at 2:30. Or is it 2:15? 2:30. I had this off again. Jeez. There we go, 2:30. Anyway, I'll get it right. Okay, so that's the after hours session. 9 a.m. we opened way up here. That's obviously outside of the prior day's high. Well, did it hold? No. In this case, we actually did come down and close the gap. So it's not perfect, but again, there's other things you need to look for to make sure that the probability is much higher that outside gaps will hold or inside gaps will fill. And if you don't have that, you don't take those trades. So that's a little bit more on gap play. And, again, I can look at the previous day, 9 a.m. on the 31st, 2:30 on the 31st. We actually care about 2:30 on the 30th. There it is, 2:30. Perfect. So that overnight and gap. I did it right this time. Yeah. There we are. So looking at the highs and lows during the regular trading hours are very small compared to the after hours here, isn't it? You're only trading regular trading hours from 9 a.m. to 2:30 in the afternoon on any given day. So 9:30, I'm sorry, 9 a.m., not 9:30 on this. There's 9 a.m. That happens to be the high and outside gap again. Well, we didn't get down to fill that gap at all. As you can see, following day, it just kept going with the trend. So overall, gaps, like I said, we have the two types that I look at. A lot of people look at different ones. Let's see if I can find the text I had here for you with the notes. There they are. And I look for the inside or outside gaps. I'm trying to put them on the same page. Where's the other notes? I didn't delete them, did I? Uh-oh, I might have. Oh, no, there it is. No, it's outside. I thought I had notes on the inside. I don't know what happened to them. Anyway, you get the idea here. The inside gaps usually try to close within the first 15 to 45 minutes. Outside gaps do not usually try to close. They usually will use the prior day's high or low as a bouncing point. So anyway, I got to run. Have a great weekend and rest of the trading day. It's not done yet. So hopefully I'll see you again. If you're interested, the link is there for the E-mini think tank. You can join me there. And actually, if you go to the link, there's a way you could try it out for free if you want. If you sign up for the quarterly subscription, because we do monthly and quarterly, the quarterly subscription gets a 2-week free trial. So if you go register for E-mini Think Tank right there, 2-week free trial. We don't even charge a card up front. So you can just check it all out, get all the education, and see what you think. So I get to run, but until next time, everyone, trade safe, trade well, and take care, everyone. See you soon, hopefully.